United Kingdom. As in the US, mortgage lenders within the United Kingdom (UK) require the rebuild value, the actual cost of rebuilding a property to its current state should it be damaged or destroyed, of a property to be covered as a condition of the loan. However, the build cost is often lower than the market value of the property, as the market value often reflects the property as a going concern, as opposed to just the value of the bricks and mortar. A number of factors such as an insurance in fraud and increasingly unpredictable weather have seen home insurance premiums continue to rise in the UK. For the reason, there has been a shift in how home insurance in both in the UK as customers become a lot more price sensitive. There has been a large increase in the amount of policy should through price compression sites. In addition to standard home insurance, some 8 million householders in the UK are categorized as being a non-standard risk. These householders require a specialist or non-standard insurer that would cover home insurance need for people that have criminal conviction and or where the property suffer subsidence or has previously been underpinned. Buying the contract coverage continues such as China, Australia, and United Kingdom use a more straightforward approach to home insurance, called building and contract coverage, commonly referred to as home and contract insurance, relative to the insurance policy of the United States. Building and contract coverage offer a very basic level of coverage. Most standard policy only cover the most basic perils listed below. Storm or flood, fire, lighting or explosion, flying trees of branches, subsidence, drag or landslide, break of glass or sanitary fittings, damage from escaped water or oil, shocks caused to the house by animal vehicles or aircraft. Building coverage. Building cover both the primary structure as well as detached structures such as garage, shields, and bricks house that are no property. However, different insurance may not cover things like boundary walls, fence gates, parts, divers, or swimming pools. So is the important to check the specific policies language. This is an equivalent of both coverage A and B in homeowners insurance policy in the United States. Contempt coverage. Contempt insurance cover personal effects such as a future clothes, electronics, jewelry, etc. Most policy limit the individual amount of money paid out for each categories of item. Individual policies can vary in the amount of coverage they provide. The option to schedules your personal property in the regularly available. Liability coverage. Liability is typically bundled together with building and contents coverage. Injuries and damage on premises would be covered by building coverage liability, while any offset occasions would be covered under contract coverage. Common exclusion. As with most insurance policies, there are always exclusions. The most common are general wear and their maintenance, fault workmanship, merchant or electrical breakdown, any amount over the limit, slow on the policy schedules or in the policies. Restricted coverage when the home is empty or the let to tenants. Bound insurance, also known as the financial guarantee insurance, is the type of insurance whereby an insurance company guarantees schedules payments of interest and principal on a bond or other security in the event of a payment difficult by the issuer of the bond or security. It is a form of credit enhancement. These generally result in the rating of the issued security being the higher of the claim paying rating of the insurer or the rating the bond would have without insurance, also known as the underlying or shadow rating. The insurer is paid a premium by the issuer of owner of the security to be insured. The premium may be paid as a lump sum or in installment. The premium charged for insurance on a bond is a measure of the perceived risks of failure of the issuer. It can also be a function of the interest saving realized by an issuer from employing bond insurance or the increased values of the security realized by an owner who purchased bond insurance. Bond insurance are monolinely by statute, which means that companies that write bond insurance do not participate in other line of insurance such as life, health or property and casualty. The term monoline does not mean that insurance operate only in one securities market, such as municipal bonds, as the term has sometimes been misconstrued. Although bond insurance are not the only monoline insurance, there are sometimes colloquially called the monolines. Bonds insured by these companies are sometimes said to be warped by the insurer. Bond insurers generally insure only security that have underlyingly or shadow rating in the investment grade category, with an enhanced rating from type B to type A.